You know how buffets most people flock to the omelette or pasta station? They might be fresh and custom made, but that doesn't mean they're the best dishes on the menu, or that they will satisfy your hunger. The same thing is true for short-term rental markets. While everyone else is fighting for overpriced properties in Gatlinburg and Scottsdale, the real money is quietly being made in markets you probably never considered or even heard of. At AirDNA, we've seen this pattern unfold repeatedly. The best opportunities aren't always where most people are looking. Welcome back to the AirDNA channel. In this video, we'll reveal our strategy for finding these hidden gems. You'll learn exactly which metrics actually matter and how to identify patterns that signal a market is ready for exceptional growth before anyone else notices. So, what exactly is an emerging STR market? How can you identify it? It's not just a small town with a few vacation rentals. It's a location showing specific growth signals that most investors haven't recognized yet. These aren't the popular destinations where you're competing against thousands of properties and paying premium prices. Instead, they're in overlooked submarkets, offering astronomically better rent-to-price ratios, better home prices, and far fewer competitors driving up costs. Instead of waiting for the next market report to tell you where to invest, we're showing you exactly how to use AirDNA data to do your own market analysis, so you can stay ahead of the game. Markets with great potential are hiding in plain sight, if you know what you're looking for. Here's our step-by-step guide to finding these opportunities. Step 1. Filter out overcrowded markets. First, let's start by filtering out the overcrowded markets. Start by eliminating big cities and metro areas entirely. These are all highly saturated, and the likelihood of finding a hidden gem is close to zero. Instead, focus on locations closer to the beach, the mountains, or a lake. Also focus on suburban or rural areas and small cities without a lot of tourists. You can do this in AirDNA by tapping the market filter and scrolling down to market types. Step 2. Target the sweet spot for market size. Filter for markets with between 50 and 2,000 active listings. Why? Well, markets with fewer than 50 listings often lack sufficient infrastructure and demand, while those exceeding 2,000 have probably already seen their prime growth phase. You'll find this under the same market filter tab. Just scroll to the Filter Markets by Listing Count scale. Step 3. Focus on proven revenue growth. The clearest signal of an emerging market is consistent revenue growth. So filter for markets with a revenue growth score of 70 or higher in the market score metrics. This immediately narrows your focus to locations showing substantial upward momentum. While rental demand is also crucial, applying both filters at the same time can restrict your results. The revenue growth score alone will give you a solid starting point. Based on this filtering process, here are some of the markets showing the strongest signals of growth potential. Fort Wayne, Indiana. Montgomery, Alabama. Dayton, Ohio. Remember, this list isn't the end goal. It's a demonstration of what proper analysis can uncover. Now, finding emerging STR markets is just the first step. You have to study these options thoroughly before committing your capital. Let's break down exactly how to analyze a market's true potential using AirDNA. First, let's focus on two important signs of a strong market: rising occupancy rates and increasing RevPAR, which is the revenue earned per available room. When occupancy goes up, it shows more travelers are visiting the area. This then usually leads to higher room rates as demand grows. At the same time, a higher RevPAR means the market is becoming more profitable overall, showing it's healthy and doing well. It's also important to dive into submarkets because some areas in a market might be performing better than others. For example, in the Springfield, Missouri market, the Springfield submarket has a 98 market score with rising occupancy, average daily rates, and RevPAR. But the Nixa submarket has a 67 market score, and an annual revenue, occupancy, and RevPAR have all fallen in the last year. This shows that strong market performance can hide underlying submarket issues, so make sure you go even deeper to get the full picture. So what should you check when evaluating a promising market to make sure it has long-term potential? Number 1. Rental growth trend. Look at how the number of active listings has changed over the past 3 years. Ideally, it should be steadily increasing. For example, Green Bay, Wisconsin's listings have grown at a healthy rate of 41%. If listings aren't rising, check if they fluctuate by season. That's normal. But if listings are consistently decreasing after a certain point, it might mean new rules or regulations are affecting the market. Make sure to research if recent regulation changes could be causing this. Number 2. RevPAR growth. Check the last 3 years of RevPAR. Consistent growth here shows the market is improving financially and that properties are earning more money each year. Number 3, demand patterns. Use AirDNA's How Does Demand Change Over Time graph to understand how demand might be shifting. For seasonal markets, compare the same month across different years. For example, in Grand Rapids, Michigan, peak demand shifted from July 2023 to August in 2024, reflecting growing demand for this market. Number 4, pricing and occupancy. Look at how much days out of the month properties are booked and how rates change. For example, in Andover, Massachusetts, occupancy dipped slightly from 2022 to 2024, but the nightly rates for December and especially around Christmas went way up, from $150 to $234 per night. This shows the market is making more money through higher rates rather than more bookings, indicating it's shifting to attracting higher spending visitors instead of budget travelers. Reviewing these metrics helps confirm if a market's growth is solid and sustainable over the long term. All the examples we've analyzed show something crucial. Emerging markets don't follow a single pattern of growth. Revenue growth scores can be misleading if you don't understand what's actually driving that growth. The data reveals 3 different types of emerging markets. Occupancy-driven. Markets showing growing visitor demand. Rate-driven. Markets where rates surge despite slightly declining occupancy. And balanced growth. Markets with healthy increases across both metrics. Understanding these distinctions is critical because the right emerging market depends entirely on your investment strategy and operational preferences. If you're considering part-time investing, well, you'll use a property yourself during certain periods, rate-driven markets might be ideal. For full-time operators maximizing year-round income, look for those showing occupancy improvements across traditionally slower months. And investors focused on affordability and appreciation should prioritize markets early in their growth cycle. The hard truth about short-term rental investing is that the most famous destinations rarely offer the best returns anymore. Saturated markets have seen property values skyrocket while returns become smaller and smaller all the time. Emerging markets flip this in your favor, offering lower acquisition costs. Often properties in established vacation destinations cost more than similar properties in emerging markets, dramatically improving your rent-to-price ratio. Less competition. Fewer professional operators means you're not competing against sophisticated property management companies. This creates opportunities to differentiate your property with modest improvements and guest experience. Regulatory runway. Many emerging markets haven't yet implemented restrictive regulations. Getting established before potential changes can give you grandfather status, which is a significant competitive advantage. Growth potential. Unlike saturated markets where both occupancy rate and average daily rate have likely peaked, emerging markets will likely go up. This creates potential for double growth. Improving operations can increase your cash flow while market development simultaneously enhances your property value. Don't get caught in the battle for overpriced properties. The real opportunities are waiting to be discovered. By using a data-driven approach, you can identify hidden gems and position yourself for exceptional returns. Start exploring emerging STR markets with AirDNA today. The power to find your next profitable investment is in your hands. If you found this video helpful, give it a thumbs up and subscribe for more guides on using data to make smart investments. Have you found an untapped market that you would like to share with us? Drop a comment below. We love hearing from you. Thanks for watching and happy hosting. See you next time.